Hi everyone. In this recording I want to share with you how we use the zones that we come up with every single morning in the trading room, and hopefully that will then help you to propel your trading to the next level, and just show you how we identify low risk, high probability setups every single day to extract as much as we can from the market. So it's by no means a methodology that never loses or anything like that, but it is a very low risk, high probability. So even in a very high probability sort of scenario where you're winning 90% of the time, there's still about 10% of the time where you go through a period of drawdown. So that's just one thing to get clear from the start, but it is a very high probability kind of trade setup that we'll look for, and we're only risking a very minimal amount. So let's take a look at the zones. Now, if I introduce you to these zones, what they represent is they represent a 20 pip, a zone of 20 pips. So from the bottom to the top of the zone, it's a 20 pip zone. The way we come up with these zones, I'm not going to go into right here, but the reason they are 20 pips is because at this point we have overlaps on different time frames. So what we do in the morning is we take a look at the different time frames, beginning with the daily chart, and then drilling down to the 4-hourly, the hourly, and then finally on the 15-minute chart, really coming up with each one of these levels where it's very likely to get a reaction. So all these levels are different reaction zones. Very high probability of reaction once price gets there. Now, what we don't know is at which point within the zone we will turn around and go the other way, or at least have an opportunity to turn around and go the other way, which then presents us with an opportunity to profit from the market. So what I used to personally struggle with is that we have, for example, you have trend lines, you have support and resistance, you have various different things that you need to look for, but sometimes price wouldn't react at this place, it would react at this place. So I would struggle with, I would take the trade here and then lose, and then see it come to the next place where I was looking to enter, and then go to my direction. So I was really struggling with those sort of scenarios, and then I came up with this idea of having actually a zone of entry where it was likely to either, where price was likely to get to. Let's just have a look at this example. Well, where price was likely to get to, and then either go from here or go from here, somewhere around there. But I didn't know which one was going to be the one. We never really do. So you don't know where the big traders are looking to take their trades from. So what you need to do is, what we look to do is give ourselves an opportunity, a buffer of entry anywhere in between here. So the way we do this is, first of all, let me explain to you the risk management factor behind this. Now, if one of these zones gets broken, like it does here, then your whole trade setup is invalidated. So how we protect our capital, with this 20 pip zone right here, we put our stop loss 5 pips above. So in total, the most amount of risk that you would be accumulating here is about 25 pips. If this gets invalidated and you break through the zone, through 5 pips above the zone or below the zone on the buy side, then the whole zone is invalidated. It's not going to work, so you don't want to be in that trade anymore. Now, how I reduce my my level of risk here is basically, this is my risk management right here. I'll show you. My risk management is based on a default stop. Risk management is based on a default stop of 35 pips. So even though my zone is equivalent to 20 pips from the bottom to the top, and then another 5 pips to the stop loss, my risk management is based on, I use 1% of my risk capital to represent 35 pips. So I give myself an extra 10 pip buffer for every single trade I take. I give myself an extra 10 pip buffer to so that I'm really comfortable with the trade. When I get in there, I don't mind losing the 20 pips. I don't mind losing the 25 pips if it doesn't work out. So this is a very key concept in my trading, where I don't change my lot size at any point during the month. I only do that at the end of every month, and I just use this because there's enough space in those 35 pips for me to be very comfortable with the risk, and enough space also to make enough profit during the day as well. So for example, today I had over 70 pips profit, and that represents 2% of my capital. And I only took risk. For example, here I only took about a 15 pip risk. Now that's another thing that I want to explain to you guys, and we can go on to questions because I understand it could be a different sort of concept to what you're doing at the moment. So we'll take some questions at the end, but just introducing you to the zone. Remember that each one of these zones represents 20 pips, and you enter the trade anywhere where price begins to hesitate within the zone. So usually, even though it's the maximum amount of risk you would take is about 25 pips within the zone, but you can make that even less. As soon as price gets in there, sometimes we get really good penetrations in the zone, like here. And I actually took this trade right at the bottom, so I was only risking about 8 pips in my trade and ended up taking 25 pips on this particular trade. So it's very it's very clearly defined. It's very low risk, and there's a very high probability of success once price gets into these zones. And the deeper it goes into the zone, the less you're risking, because your risk never your stop loss never really gets moved. Your stop loss always has to be 5 pips below the zone, and if that gets broken, then the whole zone is invalidated. You don't want to be in it anymore anyway. The whole reason for you taking the trade is not valid anymore. So just to recap again, each one of these zones represents a 20 pip buffer. So that's 20 pips, right? You place your stop loss 5 pips above. If you have a wide spread, depending on your broker, if you have a wide spread, you can do 5 pips plus the spread. I have very tight spreads on my platform, so I don't even add that in. But 5 pips above plus maybe spread, and that represents your stop loss right up here. So if you enter the trade with halfway in the zone, you're not risking the 25 pips. You're actually risking about 15, maybe 13 pips or so. And then what we do is we have. So is this part of it clear? Is this part of the risk management part of the trade of the zones? Is that clear? And if it's not, I can go through it again. Okay. So this is 5 pips above. Another key thing to remember is 1% of my trading capital, for example, it can be 2% on yours, it can be half. Whatever you're really comfortable with is equal to 35 pips. That gives me my lot size. And this thing never changes during the month. So what you want to be focused on is executing trades. You want to be focused on execution. You don't want to be taking out the calculator and working out what your lot size should be and all those things. You want to be focused on executing the trade as high as possible in the zone or as low as possible in the buy zone. Okay, I'll probably send you guys out. All the guys that are here. I'll probably send you a recording that you can watch for a day or so. Yeah. So the other thing to be aware of is just this 1% represents 35 pips. So you're very comfortable with losing this. You have to be very comfortable with losing the trade. And if 1% is not comfortable on your capital, then reduce it to half, whatever the comfort zone is. And remember that with these zones, you're actually risking half or even less of what you're comfortable with. So your trading should be really, really comfortable. Just execute, 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 execute. Okay, so that's the first part, right? That's the risk management part. Now let's take a look at the how we look for take profit targets. Now the first take profit target that we look for, there are two take profit targets, by the way. So we have two take profits, two TPs. The first take profit is a technical level which is usually between 20 and 30 pips away from the beginning of the zone. And it's usually very easy to see where that is. For example, on this euro, had we had a short trade, the technical level to take profit from would have been right here, the daily central pivot, and you have also this descending trend line. Had we gone to there, we didn't get that trade today, but had we gone there, that would have been the first take profit target, and the second take profit target is the opposite zone, and that usually represents anywhere between about 50 and 70 pips profit. So the opposite zone. So usually it's about double of what the these initial take profits are usually right bang on in the middle of the two zones. Now you probably have a question: what about if it goes to the major zones? Well, in the major zones the same rules apply. For the first take profit, you look for the first failure sort of point. Like here today, we took this trade right here, right at the bottom, because it lined up with everything perfectly. And I said in the room that the take profit was right here at 40, the first take profit, and that represented a move of about what was it? It was about 28 pips or so. So you can always find these levels very, they usually vary between 20 and 30 pips away from the beginning of the zone. You can find a technical level which was previous resistance or support, where you can take a profit. And then the second one, from these major zones, would then be the middle part of, the first failure point from the minor zone. That would be your second target on the major zones. So do you guys want me to go through that again? So what we look to do, Bogatti is asking why is long going down and short going up. What we look to do is we look for price to push up into resistance. So this is the concept, right? Sell at resistance, buy at support. So if you're looking to buy, you want to be buying as low as possible, and if you're looking to sell, you want to be looking to sell as high as possible, and then buy at support. So what we look to do in the trading room, we look to identify these levels that are very highly likely to offer a zone of support for us to bounce. And even if price fails, like it did here, even if it fails, you have enough room to either protect your trade or at least take some profit before it fails. Yeah, so we're looking for zones of reversal, reaction zones. But the key thing is that this is the key part, even if it's going to fail. So even if it's going to go down, it's very rare that something like this happens where it just goes straight through. Usually you get enough of a chance to at least put your stop loss to break even. Or I usually take half profit, and then whatever happens afterwards. And you see me all the time. I don't know if there's anyone here. Adele is probably the only one who's active in the trading room. But you usually see me taking anywhere between 50 and 70% of profit at the first failure point, at the first take profit point. So I take this profit, and then I put my stop loss to break even, and then just let it go. See what happens. If it gets to take profit too, that's even better. If it doesn't, then you haven't really lost anything. So in this case, there was one winning trade here, another winning trade right here, and this is a continuation setup that we look out for as well. So there was a short right here, which I took in my own trading, which is I mean, this is a strategy that maybe you've seen on YouTube or somewhere, which I have shared, where we look for bounces of this EMA, but only at certain circumstances. There's a filter to filter out these kind of things. But yeah, so that worked out pretty well. And then you can see on the pound, we had a kick into the zone, and then like an 80 pip spike afterwards, even after this trade. So these are pretty much the examples that we had today. I mean, and yesterday, these from Friday, I think Friday was a really good day, about 140 pips. Yesterday took another. You know what I do? I mean, I develop amnesia every single day, so I forget about what happened the previous day and just like look to focus and extract as much as possible. Because if you remember what happened yesterday, then you're very likely to be influenced by the results of yesterday with your actions today. So I pretty much forget about what happened yesterday. So it was anywhere between I think it was 70 something pips anyway. So usually we're able to extract anywhere between 50 and there have been days in July where we extracted about 200 and 230 pips. I think I posted some videos on YouTube about that. So you're able to. The key point is it's not it's not to boast or anything like that. The key point is that you can identify these high levels of probability where you get bounces and trades coming there, and even if they're gonna fail, you can still make money. Even if you're wrong in terms of direction. And if you're right in terms of direction, then you really make a nice amount. So it is a very good way of trading. It is a way that we recommend, and we trade every single day. So there's a very nice buzz going on in the room anyway at the moment. Everyone's sort of making a decent amount. Ross, what do you mean? How many times? How many times we enter a trade, or there are a couple. Every morning we do a recap between, just before we start, and I'll probably just extract the recaps and post them on the blog or something like that. There were quite a few trades. Oh yes. So yeah, I mean 140 pips. When you divide it by, and yeah, I know what you mean. So it's, if your total risk is 35 pips, then yeah, you just divide it by 35. You can see what percentage is, about 4%. But the key thing is, a lot of people find it very hard to believe that it's possible to do this kind of stuff. They find it very hard to believe that you can make 50, 100 pips a day consistently, because they haven't experienced anything like this. So it's it's an excellent way to trade if you can implement this kind of trading into your trading system or methodology, whatever you're using. Then it can help propel you. It'll make you a lot calmer in taking your trades, because you can see a visual representation of it's a buffer. So you're not panicking when it's going 10 pips against you, because you have a buffer. You've set yourself, okay, this is the buffer that I've given myself for this trade to work. And if it gets down to here, then my trade has been invalidated. The market is doing something else, and I was just wrong. So it's okay. I'll move on to the next trade. It's pretty much what happened here. So it's a much calmer way to trade, and it enables you to. I think the whole visual representation just keeps you a lot calmer, because you can see, okay, I still have a chance for this to work out, and it's all good stuff. So I think I've pretty much covered everything. I don't want to keep you guys any longer, but if you have any questions, let me know, and let's cover them. Let's cover any questions or concerns or any ideas that you might have about this, and make sure that it's all 100% clear. So shoot, guys. And by the way, I mean the way we approach this every single, we come up with these zones every single day. So it does take a little bit of work. And usually we do that between 6 and about 8 a.m. in the morning. And this is UK time. So we do it 6 to 8 a.m., come up with the zones, and these zones don't change throughout the day. They stay the same. We just trade them, wait for price to get to us. That's another key concept where you're not chasing price, you're not reacting to price, you're waiting for price to get to you, and then you're taking advantage. So it's a bit like you're the casino and you're waiting for the market to give you your odds. If the odds are in your favor, you take the trade. If they're not in your favor, you just have to stay out. So it's about reversing the psychology on the market. So Lawrence is asking whether you can get an example of the type of income you can make following this system, and what time of day is the daily setup. So we do it between 6 and 8 a.m. in the morning, set up the zones, and then pretty much waiting to execute them during the day. Now, if you see these dashed lines here, these dashed lines are alarms. If you can hear that. So once price gets to that, it starts going crazy, and I'm not staring at the computer all day. I come to the computer and then I execute my trades. The reason I don't have pending orders is because I don't, by the way, that time is UK time, so it's GMT +1, I think. So the reason I don't just have pending orders, I have pending orders on days where there's no high impact news. But when there's high impact news, things like, anything can happen. It can just go through, and I don't want to get stuck in that kind of a trade. So I wait for the alarm to come off, and then I get to the computer. I go down to I usually take these trades live, by the way, here in the trading room. The guys that are in, they can see me going down to the 1-minute chart, drawing the trend lines, and just waiting for the right kind of setup to enter. So going back to your question, Lawrence, what kind of income, that will depend on your risk. So for me, I'll use a percentage as an example. 1% is equal to 35 pips on my own risk management. This will depend on what you want to risk, whether it's 1%. I wouldn't recommend going over 2, but whatever you're comfortable with. So 1% represents 35 pips. In July, we had a record month with a return of 1,600 pips. This month is about 700. So we still have a couple of more days, but if you take 700 pips and divide it by 35 pips, it will give you 20, which means 20% basically return. So it does depend on how much you have in your account and how much you're willing to risk. But based on my risk management, this is, for this month, it's pretty good work. And last month was a killer month, 1,600. So I mean, if you take 1,600 and then divide it by 35, you can see 45%. It's possible without too much crazy stuff. We do this thing every single day, and it's when you look from outside, it's pretty hard to believe, but it's done every single day. That's why I've been posting all those videos. So Ross is asking, then sometimes your risk is less when you get in at a good, say 10 pips away from your buffer. So yes, risk is less. Now the key thing is what most people tell you to do when you're, what most traders do anyway, is if they get in a better entry, they look to increase the lot size. I never do that. I have a set lot size for the whole month. So my lot size is the same. That's why I have a default stop that I work with, which is 35 pips. But to get to your question, yeah, if I, percentage-wise, if I enter in the middle of the zone, I am only risking a third of a percent. I'm only risking about let's just use 15 pips. 15 pips is a typical stop loss. I'm risking 15 pips. That's, 0.4% based on my risk management. About 0.4%. And I'm still, I'm still looking to extract at least 1% out of it. So the risk reward ratio is always in your favor. Yeah, that's right. So Bogati is saying if you don't place OCO orders because market could be moving up and down rapidly, to take both stops out. That's exactly why. Because what I will do is, if price is moving up really fast, I will take it, but I'll take it right here. So I'm only risking about 10-15 pips. And if that works out, then it's going to be a multiple risk reward ratio. It's going to be 1 to 3, 1 to 4 risk reward. So we're always thinking about extracting the most amount of pips from the market and risking the least. This is how you're going to survive over a long period of time. Just give the market the least amount, and if it doesn't work, it doesn't work. Sometimes it doesn't work for me either, like here, but most times, boom, you're in the money. We can take one little loser. And by the way, this loser was I entered right about here when I saw the hesitation, and it was only about 15 pips. Yeah, so Ross, you're exactly right, and that's the reason we don't place the pending orders in there. However, I do understand concerns that people that are working have, where you can't really monitor the market, but there are certain times of the day where we do take. Well, I'm not present I'm not staring at the charts all day, so either an alarm is going to attract me to the screen, or which are these dashed lines, or a time of day. We have 5 different times of day. I'm really big on time of day. If you get a trade at the right time of day, the probabilities are crazy. It's like 95%. We did get that here today. Excuse me, we did have that here today, but sometimes they don't really work out. The market gets into your zone at a different time of day. That's okay. The zones are there to basically just inform you where the highest probability of a turnaround is, and that's it. It's still a probabilities game. Yeah, definitely, Ross. Yeah. I'm going to update the results for this month. It has been a little bit slower, but it's still very profitable. So August has been a little bit slow in terms. There hasn't just been a lot of action, but it's definitely. Now the key thing is you have 2 things, right? There's one thing to consider is the probability of success, and let's just use a number of 70-75%. So one thing to consider with any sort of methodology or system is probability, but the second thing to consider, and we went through this in our basic course that we're recording at the moment. One thing to consider is probability. The second one is the risk-reward ratio. Now, you have some systems out there, and because you guys are trading, you probably know, like Fab Turbo and whatnot. These kind of systems have a probability of success about 90%. However, their risk-reward ratio is out of whack. They're risking, I'm not really sure, I can't remember, I did try it out some time ago. It was anywhere between 5 and 10% of capital in order to give you 1% return. So correct me if I'm wrong, but it's going to be easy if I use the 10%. It's going to be easier to make the point. So for every one loser that you take, for every one losing trade that you take, you have to have 10 winning trades in order to make up for one loser, which means that you need a 90% success rate in order to be at break even. That's why these kind of systems have to have a 90% success rate. With this kind of methodology, because our risk-reward ratio is always in our favor, we're always risking less than what our reward is. You know, it's usually at least a 1 to 2, but like with this trade, this was a 1 to 5 right here. High probability trade as well as high reward to risk. This was uh, this was a 1 to 2 just at the first failure point. So you're risking 1% and you're getting 2%, or you're risking 10 pips, you're gaining 20. Here you're risking 10 and you're gaining 1. So you have to have a bit, I mean, it's psychologically you're thinking, oh yeah, I'm making money because, you know, all the time, boom, 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 boom. I can see 9 trades in a row that won. Okay, yes, but one trade is going to take 10 trades away from from your balance, and that's it's not a good. You're going to be living in fear with these kind of systems. But with this, you're always in control, and the best thing is that you know why it's working because you've identified these levels. You're identifying them every single day. You can see them happening. And what we do in the morning in the trading room is I spend about 15 to 20 minutes recapping. So this stuff that we went through with you right now, I'm going to spend about 20 minutes as we open in the morning just to recap what actually happened, so that you get the affirmation that what you did was right, and you can identify what you did that was wrong as well, whether there was anything technically wrong or whatever the reason was. And then you go and approach your head you approach your day with a cool head, with a fresh mind and fresh fresh picture for the next day. So it is a really good way to trade. I think um, I haven't seen anything that's been done that's similar out there, and I just want to scream and shout to tell everyone it is the way forward. So, but yeah, if you guys want to check it out, then you know you're more than welcome to. I'm gonna post a link later on, and you're welcome to come and check it out and see for yourself. But in terms of tonight's webinar, the I hope it makes a little bit more sense how the zones can be advantageous in your trading, to help you visualize and to help you manage your trades a little bit easier. And this is the core of my trading. Now, I do get asked, why don't you trade other currency pairs? First of all, we did try implementing other currency pairs, and they haven't been as successful as these two. Second of all, you're dispersing your energy, so it's not very focused, and I don't really like, you know, we spent 2 hours analyzing the, okay, not 2 hours, but about an hour to an hour and a half analyzing these pairs and working out every single strategic detail of how we're going to attack the market, the plan for the day ahead. And once you do the plan, you know, you go from there are 2 jobs we have as traders, right? One job is as an analyst, and the other job is as a executing trader. So you're executing and managing your trades. Now, the job as an analyst, you're doing early, and we're doing early between 6 and 8 a.m. our time here. For the rest of the day, you become an executing trader. There's not a lot for you to think about. You're just looking to execute your analysis in the morning. Funds, hedge funds, have one team doing this and another team doing that. Yes, we're doing 2 jobs, but if you want to be a professional trader, you need to become good at both of these things. And what my trading room basically enables is just bridging the gap between the two. And you can see these things working out day after day after day. Okay, I will do, Lawrence. Thanks for coming in anyway. So I'll send out an email right after this webinar. But any questions that you guys have, also, you know, drop me an email. You know my email. I think most of you are on my mailing list, and if you're not, then info@derovic.com. or post something, drop me a message on Facebook or whatever. I'm on Twitter, Facebook all the time. So any questions that you have, I mean, I do want to spread the message because I see a lot of people struggling, but at the same time they're very skeptical. And there's a lot of good salespeople out there that get people sold on different things that don't work, and I do understand that. But if you want to be successful, this is a really good way to make a consistent income in your trading every single day. It does require a little bit of work, but if you want to make, putting in 2 hours of work a day, is that really too much to ask for something that can generate? Once you become good at this, you can begin trading people's money. People are going to start approaching. I get approached all the time by investors. You can start doing the stuff that I'm doing, coaching people, and there's so many opportunities. So it's just a huge amount. But once you get good at this, and you can get good at this with a little bit of practice, it might take a couple of months, but you go to university for 3-4 years to get a degree, and then you're struggling to get a job. It's a bit of a, I don't understand the logic sometimes. The programming that we have is that we go through, where we'd spend on something that's not working, and then when it comes to something that's working, then we're sort of hesitating and second guessing. But any questions that you guys have, you can shoot now. We can cover them. And I think in terms of the content of the webinar, I've covered everything I really wanted to cover. So you're welcome, Pagat. So yeah, guys, I mean, sure, there are systems out there that work. Like I said, there are constraints between both. There are constraints between systems which work in trending markets and in ranging markets. One is going to work at some point. For example, the euro dollar is only trending about 20 to 30% of the time. That's how much it trends. If you have a trending system that you're using, you have to be willing to lose 70 to 80% of the time in order to be in those winning trades 20 to 30% of the time. I have developed systems which are profitable with only 20 to 30% of time. With good risk management, you can make a system which is profitable, which only has 20 losing trades out of 100. It's possible. Some of the best traders in the world, because they're managing so much money, they cannot be in and out of the market like we can. And we can be in and out of the market even if we're trading with, if our account is 20, 30 million or whatever, you can still be doing these kind of things. But once it gets into those 500 million, those extreme numbers where you're managing huge funds, you cannot be doing things like this. Then you have to build a position. You have to trade for a long period of time, for a month, year, 2 years, 5 years. And then, if you catch a trend that's going to go for 5 years, you only need 2 trades out of 10 to work out. And you just build a position, a huge position. So you can have systems that work like this. For us as intraday traders, if you want to get paid every single day, you want to focus on where the money is 70 to 80% of the time. And the money is 70 to 80% of the time in strategical, attacking the market strategically every single day. Boom, 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 boom. In and out, in and out. I am done at 4 p.m. A lot of traders have sleepless nights because they're in trades which are lasting, I don't know, however long they're not in there. They have 150 pip stop loss. I have a 20 pip stop loss. If this thing gets out, if it hits my stop loss, that's it. Boom, I'm out. There's nothing to worry about, nothing to bite the nails for, and all that stuff. So it's very calm, and it's strategic. I mean, logical, strategic way to attack the market every single day. I like that. It even rhymes. So how did you guys find it? Useful, not useful, good, bad? What's the feedback? Okay, cool. You can check out everything is pretty much on the blog, but you can check out the YouTube channel as well. It's all connected. So there's some really good stuff that I recorded recently, especially if you can. You can check out the 5 pillars webinar. It's about half an hour, but very, very useful. Yeah, my blog has got most of my work, and I do post stuff on Facebook as well. So connect up on Facebook too, and Twitter if you're on there. It's the only thing is that over the last however long it had, probably a week, you're gonna see my videos doing recaps every day, but they take me an hour to do because I have to record the recap, then post it on Facebook, post it on Twitter, post it on the blog. It takes about an hour to do. So I've been a lot more and more busy. I do have some funds that are following me as well. They're interested in the stuff that I'm doing. So it's been a lot more work. That's why I haven't really been recording them. But the results have been there. The results have been good. Well, really good. And some of the stuff that you see out there, I mean, I know exactly why people are skeptical, but some of the stuff that you see out there where someone posts, okay, we've just, we've had 1,000 pip month. Okay, you've had 1,000 pip month, right? What's your risk per trade? When you look at their risk per trade, it's 150 pips, 200 pips. It's like, I don't want to be risking 200. Are you mad? That's crazy. Well, in my world, I don't want. For me, this is sleepless nights. For me, this is smoking a pack of cigarettes when you're not a smoker. I don't like that. I don't want to live like this. I want to be done 4 p.m. UK time. I'm done. Actually, there's one trade that we have, which is at 4 p.m. It's a strategy with. I do have someone working on automating it. There's one strategy that we look for at 4 p.m. And then if that doesn't work out, well, it's either there or not. You either take it or you don't, and just leave it for about half an hour to an hour, and then take it off. So, but pretty much 4 p.m. usually I'm done. Come into the trading room and I'll tell you. Check it out. Trust me, you're gonna make many times your return on your investment. If I had something like that when I was learning, I would have taken it with both hands. Yeah, the trading room is it's in dollars. It's $147 a month. But I think the value that you get in terms of trading is just, in the right hands, it's worth thousands. So what we do is, let me just guide you through. What we do is 6 a.m. I open the room. So 6 a.m. we open. 6 to about 6:20, I'm doing a recap of the previous day's trades. So tomorrow morning when I open up, I'm gonna go through this zone, that zone, what happened, how much we made. We're gonna see if anyone had any challenges or anything like that. Yeah, British time, so UK time. Did you say you're in Vienna, Chris? I think it's an hour ahead of it, or is it behind? Yeah, so it's probably like 7 a.m. your time. Yeah. The reason why we open at 6 is that we have a trade which is at 8 a.m. and 8 a.m. London traders are in the market. So you want to be ready for battle at 8 a.m. You don't want to be doing your analysis at 8 a.m. This is a very common mistake where people are coming in, they're doing their analysis, and the market is running away, and they're not prepared, so that they have to do something. They jump in a trade, then it doesn't work out, blah blah blah. No, we're a step ahead. So 6 to 6:20 we do a recap, and then between 6:20 and 8 we're doing the full analysis on euro and pound. And then I put the news on from 8 to about 1 p.m. We have the news on running, institutional news, live. So whatever news are coming out, and we're here chatting like we're chatting here in the chat box. Everyone sort of, if there's anything going on, but pretty much you're waiting for zones to get hit. You're not doing anything. You're just waiting for zones to get hit. This is, this is professional strategic trading. And then I take the mic at 1 p.m. to do a recap of, to do a review for New York, because New York traders come in at 1:30. So for about half an hour we'll do a New York recap or New York review. And then there are trades that we look for at 1:30, there are trades that we look for at 2:30. And during this time we do have the news on as well. And then the 4 p.m. there's another trade that we look for, plus the zones. So anywhere, when you're trading this way, you're going to be taking anywhere between about 2 and 8 trades a day. And the 8 trades should really be a maximum. It's like all these zones getting hit. 4 trades here, 4 trades there. But that's pretty much it. So there's enough action. You don't want to be doing too much. For me, it was a case of reducing my trading in order to be more profitable, if that makes sense. So I used to go through, when I was trading before, I used to be trading like all the yen pairs and all that stuff, and some of the guys in the room do that too. But I find that I make enough of an income doing this that I don't need to be doing all these other things. It's dispersing my energy. I'm not focused enough. So what used to happen is I'd make in the day I'd make something like 300 pips or something crazy, 300, 350. But then I would lose 200 and between 260 and about 300. So at the end of, so I'd win this and I would lose this. And at the end, when you sum everything up, pull the line underneath, you come up and you've made 50 pips, but you've pulled your hair out through this time. You've gone through a whole lot of stress. So that's when I realized, okay, maybe let me try something different. Let me try being focused on 1 or 2 pairs where I can be really, really specific, really, really detailed. And now I can make anywhere between, there have been days where I've made 200, this is not a common result, 200 pips in a day or whatever, but anywhere between 50 on a slow day and about 200. There are some days where it's even less. It's about, like Monday was a 20 pip day, but it didn't move, so couldn't really do anything, but it averages out. The key thing is that over a month you get a good average, and that's what you have to do. You can't force yourself onto the market. The market has to give you, it has to feed you. You can't really take something by force. And that's another thing that's another common mistake that people make anyway. It's just these 2 pairs, Chris. Chris is asking what pairs do we trade. Well, I just trade these 2 pairs. I don't need to trade anything else. And all the results that I've been posting have just been euro and pound. You can try the methodology on other pairs. I have one of the guys here in the room. If you join in, you'll meet him. He trades the yen pairs. Well, he focuses on euro yen. There's another guy who tries different pairs. So it's entirely up to you. But for me, the best results have been on this. And like I said, I have made these kind of results, winning 300, losing 200, and you're sort of going through a whole bunch of stress and being losing a year out of your life every single day. And that's why I choose to do this, and it's providing similar sort of results, but a huge, a lot less stress in terms of trading. It's just focused, calm, execute when you get your trade, and that's it. If I were to expand my horizons, I would have to add another hour or two to my day of work to in terms of the analysis work. So remember what I said, we have a job of an analyst, which we do in the morning, and we have a job of an executing trader. Now both of them are very important, so both of them are skills that you need to become good at, but with with enough practice you're going to become good at them both. And a lot of the people that are here in the room, they come in with they follow the analysis. They might not do the analysis themselves, but because they followed it, it sinks in with repetition. So repetition is the mother of all learning. So because I have the same approach every single day, after a week, you can pretty much, it's sunk in. So when you try to do it yourself, you're like, okay, so yeah, this, oh, okay, let me do this and then check this out and then that. So it's a very methodical and strategic approach, which is the same every single day. And this is one thing that we referred to earlier about consistency. Consistency begins with you. If you have a consistently the same process that you approach the market with every single day, then you will then the results will be consistent as well. The market's going to change, but I don't have the same amount of pips every day. Whatever the market gives us, we take, and we've been taking as much as we can. But that's why there are some months where you take 500. There are some months where you take 500. 500 is still about 15%, by the way. 500 pips. There's some months where you take 1,000. There's some months where you take 1,500. And I'm sure approaching this September, October, November, there are going to be months where we have even higher records, hopefully. We have some good months coming up. So August has been pretty slow. Even though it's been slow, it's still been a good month. And yeah, we do have some months. By the way, there is if any one of you wants to sort of join in for a year, there is a special discount of 20%. So if that's something that interests you, cool. But thank you guys for coming. I mean, I've held you here for about an hour, so I think it's been useful. We've covered some really cool stuff. If anything, I hope it helps you in your trading. Thank you guys. Have a good night, and hopefully I'll see you tomorrow. If you decide to check us out in the morning, I'll see you in the morning. Cheers, guys. Take care. Bye bye.